We're elevating UD insight to a global level. Here's the English article, Data-Driven and Strategic. The emerging global economic war is Indonesia set to win or survive? The world faces structural realignment, not a typical slowdown. We see a transformation of the global economic architecture, significant since the 2008 crisis. Consider the hard data. Global debt exceeded USD 310 trillion in 2024, IMF. US interest rates are near a decade high. BRICS now accounts for over 40% of the population and 30% of global GDP. Supply chain diversification away from China is accelerating. This is restructuring, leading to both winners and casualties. 1. The end of pure globalization, from efficiency to security. Globalization focused on efficiency for 3 decades. Manufacture cheaply and consume where purchasing power is strong. That era is fading. Europe diversified energy supplies post-geopolitical tensions. The US imposed semiconductor export controls on China. Corporations now adopt China Plus One strategies, moving production to Vietnam, India, and Mexico. The focus is on strategic resilience over cost minimization. Supply chains are redesigned for geopolitical security, which incurs higher production costs, redundant networks, and increased capital expenditure. The global economy is fragmenting into blocks. 2. Higher for longer, the new monetary reality. The era of ultra-cheap capital has ended. Central banks, especially the US, Federal Reserve, maintain restrictive policies to curb inflation. Consequences include US Treasury yields at 15-year highs. Volatile capital flows to emerging markets. The US dollar remains the dominant reserve currency. For emerging economies, this leads to currency vulnerability, higher financing costs, and sensitivity to foreign flows. In a high-rate environment, leverage is risky. Liquidity is power. 3. Indonesia's strategic position in a fragmented world. Indonesia stands at a critical intersection. On the opportunity side, Indonesia has vast nickel reserves for EV production. Annual GDP growth remains circa 5%, outperforming many developed economies. Public debt to GDP is moderate. It maintains a neutral geopolitical stance. In a relocating supply chain era, Indonesia can be a strategic hub for minerals and EVs. However, risks include high reliance on commodity exports and sensitivity to capital flows. Indonesia is well-positioned but not insulated. 4. Investment Strategy 2026-2030. Structure over speculation. In transitional eras, speculation fails. Investors need to adjust their strategies. 1. Strategic commodities are vital. Energy transition drives demand for nickel, copper, and infrastructure. 2. Industrial infrastructure is crucial. Supply chain realignment requires ecosystems like industrial estates and logistics. 3. Safe haven allocations matter. Gold appreciates during geopolitical tension. Diversification into defensive assets is strategic. 4. Watch foreign capital flows. Emerging markets, including Indonesia, are sensitive to foreign portfolio movements. 5. Preserve cash and flexibility. In a high-rate world, strong balance sheets matter. This isn't a cycle to chase momentum. It's a cycle to build deliberate positions. 5. The 3-5-year outlook. A divided but competitive world. In the coming years, 3 trends are likely. The global economy will form at least 2 to 3 major blocks. The US dollar remains dominant, but alternative systems will expand. Neutral economies like Indonesia will be strategic capital arenas. Volatility will be the baseline condition. Positioning, not just growth, is vital. Final insight: crisis or strategic reset. Major economic shifts create 2 groups: those who react emotionally and those who analyze structurally. The current environment isn't merely a crisis, it's a strategic reset. The global order is recalibrating, financially and geopolitically. For investors and policymakers, the goal is not to predict headlines, it's to interpret direction. In a noisy world, clarity is a competitive advantage. That is the essence of strategic thinking. That is UD Insight's foundation.